Hi, everybody. Welcome to Minneapolis Area Realtors Residential Market Update for March 2023. My name is Jackson Pino. I am your Policy and Research Manager, and I'm going to walk you through a series of market updates, including how those market updates interact with some recent events that have been going on in the banking industry. And I want to make sure that you're staying informed on everything that's going on and what that could mean for you. So we will connect that to inflation, interest rates, and what to expect for you and your clients. If we have any time after that, we'll have some questions. Please feel free to put questions in the chat so that way I can see them. I can't see the Q&A while I'm doing this, so please feel free to ask questions in the chat. Otherwise, I'll get to Q&A at the end. So, mantra of this webinar comes from President Dwight D. Eisenhower. In preparing for battle, I've always found that plans are useless, but planning is indispensable. Put simply, we're going to go down some potential rabbit holes. But, oh, I have a significant echo. Okay. No, I'm unfortunately in a very empty room. I don't think it is going to be helpful for me to put headphones on. I think it will only make it worse. But good to know for next time. I appreciate that. Is it bad enough that you guys can't hear me at all? Or is it just kind of annoying? It's fine. Okay, I appreciate it. Sorry, everybody. I'll try to speak more quiet, I guess, so that way it's not bouncing off the wall, right? But in preparing for battle, I've always found that plans are useless. Planning is indispensable. What I mean to say here is that we're going to go down the rabbit hole of some hypotheticals, especially when it comes to recent events in banking. I don't want you to take what I'm saying as absolute truth forecasting that's going to happen. I want you guys to think about the potential impacts of what that means for your business so that way you can be planning and not just accept it as a plan. I want you to be thinking about things and mulling them over appropriately. Hey, David. So let's move on with our market update, the good old regular standards that I know some of you come here to see, right? This is going to be looking at February as a whole. February new listings. We are down about 24% from last year. What does that mean for us? Right? It means that 24% fewer homeowners are willing to put their home up on the market in February compared to less. This is expected to a certain degree. Why is it expected? We are seeing this happen because there is less demand in the industry. Move over to that demand side for a second, but remember that we hit a fever pitch, you know, of activity in 2022 and 2021 in particular here, and sales were still down. Now, without that fever pitch, we saw that 24% drop. Keep in mind here, and throughout the rest of these charts, February of 2020 is the last full month prior to the economic impact of the COVID-19 pandemic. That was the last full year. 2020 of March is when we started seeing significant impacts, right? So on the pending side, why are there fewer people willing to list their home? It's because there are fewer people who are eager to sign on purchase agreements. We saw a similar drop, 24% drop in signed purchase agreements for February of 2023 compared to February of last year, and which is down still from 2021. Now, keep in mind that demand has an impact or is impacted by mortgage rates, right? And mortgage rates have been significantly impacted by the Federal Reserve. We've been talking about this for a while about how the rate hikes from the Federal Reserve have impacts on our industry. This is one of those impacts that we're seeing. So don't be surprised if we're not seeing tons of offers like we used to, right? And as pending sales is a leading indicator for next month, this won't be far off from what we will probably see in closed sales for March. In the same vein, closed sales in February is also down, similar to what we saw in pending sales last month, right? Still down from the previous month, and down even more than our relative high that we saw in 2021 at about 3,200 closed sales in February of 2 years ago, right? Now, with this decrease in demand, that means that the homes that do end up going on the market spend a longer time active on our MLS. We are no longer seeing the weeks or week of being on the MLS before you get a signed purchase agreement. It is now kind of snapped back. And I think that's a good model to have with a number of these. Rubber band being pulled tight during COVID, right? It's now snapping back to what it was prior to that rush, right? It's now 44 days for half the homes on the market to end up finding a buyer willing to sign a purchase agreement, right? So when your clients are now asking how long will it take to sell my house, this is the new answer. No longer weeks, but closer to a month. So original list price. Let's talk about setting expectations, right? Expectations for the past couple of years were pretty high, right? Of a original list price should keep exceeding, right? But that's not really what we're seeing in the long-term data, right? So since the recovery of the recession, right, and moving on in from 2012 all the way up to the present day, that looks like a pretty linear straight line, you know? Yes, we did see double-digit growth in 2021 to 2022 for the month of February, right? But we're not seeing that same double-digit growth in original list price anymore. And that is a sign of stable linear growth. We're now at just shy of $395,000 for an original list price in the MLS. Right? And this might be what you're seeing. I wouldn't be surprised if some of you are having conversations like, hey, Mr. or Ms. Realtor, Zillow said my house is worth $400,000. You have to give them the reality check, you know? Probably not the cat here saying 130, right? But definitely giving them a sense of reality of where that market is right now. And now it's not what it was a year or so ago. Talk about another reality check. This one's a little harder to swallow. Is sales price. Median sales price is $340,000 for the month of February. That is 0% growth from what that was in February of last year. This is the first time that we have had 0% growth on a monthly, but from just looking at a particular month, from one year to the next, in years. You know, I mean, we haven't seen a negative change in February's since 2010 to 2011. You know, that's recession era, numbers right here. Now, what's happening? And let's kind of dive into it and make sure that we're aware of what this looks like, so that way we're not raising alarms unnecessarily, right? Another way to view this is looking directly at the change itself. So we're no longer looking at median sales prices. We're looking at the magnitude and direction of that change in sales price from year over year for each month that we've had since we've been reporting, right? And there is one significant area where we had negative sales price growth or sales price decreases, right? That was during the Great Recession. Apart from a short tax credit period that gave us some positive growth, right? We generally saw negative growth around that time. Once we started to recover in about 2012, there was a bit of a boom. You see, double-digit growth here, right? And then the market started to level out, and we had a sense of stability in price growth. That's good. That's what we want, right? Constant, stable price growth. And then COVID happened. You can kind of see in brackets here, I framed the COVID-19 pandemic, right? And yet again, we saw another boom in sales price. Again, up to a height of almost 17% sales price growth from one year to the next, right? Now, the red area all the way off to the right here, I've highlighted to drag your attention to it. That is the first full month that we had an increase in Federal Reserve interest rates, therefore trickling effect into increase in mortgage rates, right? And that price growth has started to come down. Still positive here, even though it's in red. It's still positive growth, but it's just smaller growth. Think of it as like depreciating returns, so to speak, that flattening out of price growth in a way. Now, there's a space right here because there's no price growth that we had from February of last year to February of this year. We could see, and hopefully, we see this number come back up and be similar to what we saw in 2015 to 2019. You know, could be small growths, could be big growths, but relatively stable. You know, it could get back there. We don't know yet. We gotta keep waiting, and as soon as we start knowing whether or not we're dipping down, we'll let you guys know. But we are at that point where the impact of rate hikes from the Federal Reserve are being felt here in the Twin Cities in terms of median sales price. So another way to look at this is price per square foot. And yet again, you see this $186 per square foot as a median has not changed. Okay. It's probably rounded to the cents. It's gone down a little bit in terms of cents, right? But dollar for dollar, there has been no price change, you know? Percent of original listing price received. This is very interesting, and I think that the dynamic here at play is something that you will see out in the field, right? Prior to looking through the recovery into just the years before the pandemic, we were increasing up to original list price of being 98%, give or take, right? COVID hit, and all of a sudden we had 100%, maybe even a little bit more, right? And there was probably a wide range in there. But now, like I said before, that rubber band has snapped back. We are now back down to 97, close to where we were at before, right? Now, it begs the question, where along that process from listing to signed purchase agreement is that reduction happening? And I think this next chart alludes to that in many ways. February percent of current list price has been and continues to be at 100%. So what these two charts are telling me is that we have seen a reduction. We've seen a reduction at the point of listing. You're setting a home at $380,000. You're not getting any bites, you know. You lower it to $340,000. You're not getting any bites, right? You then list it at 320, and all of a sudden you have piranhas all over you. You know, you might have 5, 6 buyers at that point in time. So the negotiation price is happening at the point of lowering that price down. Once you're at the current list price, that's when you're getting people hopping. You're not seeing negotiation once you've set that price where the buyer is willing to sign. So, inventory. Let's take a look at our active inventory. And just a reminder here of what our methodology is. Inventory for us is a snapshot at the end of the month of what is available, is under active status in the MLS. It's not going to capture homes that showed up on February 2nd and then had a signed purchase agreement on February 15th, for instance. But this is a consistent way to show you that what's left at the end of the month has gone down and has stayed down. Yes, we are up 9.3%, but that's about where we were at in 2021. We are not quite at the inventory of what we were at pre-pandemic at about the 8,500-ish number. We're certainly not back to where we were at a more balanced market in 2013, 2014, you know, 10,000, 13,000. And we still need to get back there in order to get to what we are considering a balanced market. And I know some of you have probably seen this in terms of month supply of inventory. We are still down as well. We're not at the 5 to 6, 4 to 6 months of inventory that we would need, in order to have a balanced market. For those of you who are not familiar with this, you might be new. What is month supply of inventory? Essentially, if we were to take our current inventory right now, and we were to not add any more homes to the MLS, how many months would it take for the MLS to run dry? And right now, that's about 5 to 6 weeks, which is not the 4 to 5 or 5 to 6 months that we would want in a balanced market, right? In fact, we haven't been in a balanced market since about 2011, 2012, realistically. And let's talk about this relationship, right? We're currently in a seller's market, which means low supply, high demand. Few homes available for a lot of people that want to buy them, right? Not quite as high as we were last year, fair. But what we're not in is the buyer's market with more than 6 months supply of inventory, where there are a lot of homes available and few people interested in buying them. Ideally, we want to start to balance somewhere in between, where there's roughly an equal number of people interested in buying as there are people interested in selling. Neither side has an advantage, and the price growth is stable. Right? And with that in mind, at the note of stability, I want to make sure that you guys are aware of the recent story of instability that has been going on, and talk about it because it is in the news. And banking, when there are concerns about banking, realtors listen, right? Because it is so closely tied to our industry. So banking turmoil. What happened to Silicon Valley Bank? What does it mean to the Twin Cities real estate market? I'm going to paint with a relatively broad brush here. So if you guys have really dug in deep and you really know, don't get into the chat and blow me apart. I'm trying to give you like the need to know rendered down basis, right? But let's talk about what um, Silicon Valley Bank. Silicon Valley Bank is a regional bank that grew rapidly throughout the initial onset of the pandemic. Why? Because it, for the past 40 years, has built a banking franchise surrounding the tech industry, whether that be startups, companies, founders, venture capital firms, or all of the employees of such that need private banking. And when this entire tech industry grew, so did Silicon Valley Bank, as you can kind of see here in the onset of the pandemic. Man, they blew up throughout 2021. Those deposits of this bank, I'm seeing in reporting, grew by 86% just in 2021 alone. Now, just like everyone else, they felt the impact of consistent Federal Reserve rate hikes. But unlike everyone else, and unlike many other financial institutions, they were so closely tied with the tech industry that when the tech industry started to see a downturn, so did they. They started seeing large and frequent withdrawals and closings of accounts. And that became unsustainable for them. Why? We will talk in detail in a second. Because it was unsustainable for them, SVB started to try to find, them and their advisors tried to find a way in which to help get the cash on hand in order to process these withdrawals and account closings. They couldn't do that, so they ended up doing what they could. What they could is another thing we'll put in a pin for just a minute. But they ended up doing a last resort move that ended up reporting 68% stock loss and major distrust in their bank over a 36-hour window. By March 10th, SVB was in crisis. And the FDIC came in before the start of business and shut down the company in order to return funds to all of the current account holders of Silicon Valley Bank, and they're no longer existing. So troubling, right? And it begs the question: are banks failing? No. Silicon Valley Bank is unique in very important ways. Those pins, we can have a pin to talk about now because they are very unique to what's going on with SVB. So, like we said, Silicon Valley Bank is focused on the tech industry. The tech industry is also very focused. They are focused predominantly around the San Francisco Bay Area. In fact, Silicon Valley Bank has almost all of their branches, or had almost all of their branches, in the same area where almost all of Silicon Valley's tech industry is. Quite fitting for them, right? It was designed that way. What is also very important to know is that 85% of the deposits in Silicon Valley Bank were over $250,000. That may sound familiar to people because it is the FDIC insurance limit. We can have that conversation, but I don't think it's necessary for what I'm doing here. I want you to know is that 85% of the deposits in this particular bank were not your mom and pop $100,000 startups. They were millions, they were tens of millions, there were hundreds of millions of dollars in deposits. Well beyond the insurable limit, sure, but also a lot of cash coming in very quickly. So let's go back to 2021, right? Cash was flowing in faster than this small regional bank could lend out because they're so concentrated in the San Francisco area. So SVB did what they considered to be the safest thing. They put as much money as they could, over $21 billion, into what they considered at the time to be super safe treasury bonds, a guaranteed 1.3% return on that $21 billion after 30 years. But when tech started to tumble because Federal Reserve started increasing rates, and at the same time, venture capitalists closed their wallets and startups burnt through all their cash, because that's what they do, deposits fell. People started coming in asking for their money because either they were laid off or they needed to declare their own bankruptcy as a startup. And at that same time, down at the bottom, you'll see interest rates on these bonds ballooned twice of what the super safe treasury bonds and the SVB invested in. And so therefore, the value of the SVB bonds also fell. So they had a problem, right? They made essentially a risky investment, one that they thought was safe, but in terms of the terminology, it was a duration risk, right? And they didn't necessarily prepare well for major job losses, major tech closings, major layoffs. And so all of a sudden, they had a lot of people asking for their money and didn't know how to give them that. They had their advisors go and try to find private resources, but private resources were either unwilling or incapable of helping gain access to the type of funds that SVB needed. So they did the one thing that they could do. On March 8th, the bank announced that they sold that $21 billion worth of bonds at a $1.8 billion loss, because it was all that they had, or the vast majority of the way that they could get money into the people who needed it, who were asking for their money. And then their stock tanked. We say, oh, we're going way too fast now. We say that it's a risky investment. In fact, I think the head of the FDIC said it best, was for a company that was so laser focused on the tech industry, they did a really bad job paying attention to the tech industry. And you can see on the news headline here, tech industry jobs laid off more than 95,000 employees last year. That doesn't even mention the 120,000 employees that have been laid off in the tech industry since the start of this year. And that head of the FDIC said for them not to pay attention to that and start getting the cash on hand appropriate would be like being the owner of a ski lodge and not looking at the weather forecast, seeing that it was snowing, and preparing for snow on the mountain. Yeah, not good. Now, of course, Federal Reserve rate hikes were the indirect cause of all of this, right? That's what ended up being a negative impact on the tech industry after all, right? And it ended up being a negative impact that caused the value of SVB's 30-year treasury bonds to go down, right? But everybody was kind of feeling that. So the big question now is, are our efforts to combat inflation bringing negative consequences? Even though it's, SVB is unique, it's all about perception, right? It doesn't matter if you can, give all these excuses about how unique SVB is, if people are still concerned about how safe their money is in smaller banks around the country, right? And we're seeing butterfly effects of this now. In fact, investors are especially wary of banks that grew rapidly, particularly if they're regional banks, and are holding on to hefty deposits from businesses and people who got really wealthy because of rapid inflation or big, advancements through the COVID-19 pandemic. Shares of First Republic Bank, once considered a star of sorts in this industry as a smaller bank, not one of the big ones, has fallen 30% in the past week. So it perception has an impact, even if it's misperception. Right? So let's understand this a little bit, right? We got four big banks here. These are some of the four biggest banks in the country. A lot of resources there, right? And they do direct business with the Federal Reserve, right? They give money to the Federal Reserve in exchange for, the intended rate on return that they're going to get for investing in money, right? And they have the money to do that. The regional banks engage often with but also with these larger banks because they have those assets, right? And then we have us, the people, who can definitely engage with the big banks like Bank of America, Wells Fargo, JP Morgan, TD Bank, whatever, right? But they also engage with the smaller banks, and SVB is one of those small banks that just went under. And so the perception of a potential, the concern of a potential bank run, right, is that if that could happen with this small bank, what happens if a similar weird, quirky thing happens with my small bank or credit union here, maybe in the Twin Cities, hypothetically, right? Should I take my money out of those other banks and put them into banks with high, more reserves, more assets, more money, more access, that sort of stuff? Now, I'm not saying that that's happening, but I'm saying that those are the potential butterfly effects. Let's reel it all the way back to Dwight D. Eisenhower, right? This plan may be useless, but the planning is what's helpful here, right? Don't walk away with this thinking that Jackson's telling you there's going to be a bank run in the Twin Cities, because that is, I do not believe that. But walk away knowing that there may be changes in patterns of practices. There may be impacts of this. And if people make a big enough mountain out of a molehill in any way, that's going to impact your business. And I want you to be aware of that. And so how is it impacting your business, right? So starting from the source, right? We know that we have seen the federal funds effective rate go up to, looking through the onset of the pandemic, we're at a high, right? And that is impacting our mortgages, or the mortgages of our clients. So how do we set up expectations for our clients, both on the buying and the selling side, right? Put simply, and I know you guys already know this to a certain extent, your clients are going to be looking at prospective homes. Your buying clients will be weighing those options. They'll be doing the math out, and they will see that their dollar doesn't stretch as far as it could have a year or two ago, right? Maybe that means that they're not able to afford the $380,000 home. They're gonna have to try to find some way to work out the $300,000 home that is similar but way further away from city center, or is in the area that they want but is a 3-bedroom home and the kids are going to have to share that bedroom. They're going to start making compromises like that. Why? Because monthly payments are up. In fact, we used to tell you before this, when we were in the onset of the beginning of the pandemic, that, hey, take a look, monthly payments, because interest rates are so low, they're similar to what they were at, in 2005, 2006. Excuse me. That's good. That's a benefit for our buying clients, right? Well, interest rates have caught up. Mortgage rates have gone back up, and we have now yet again seen that elastic band, that kind of metaphorical elastic band, snap back to a reality, a linear trend of sorts that we really have been seeing since 2012. and we were getting a deal. And now that deal has been corrected for because the Federal Reserve wants to incentivize people to stop moving money around in exchange for goods. The goods in this case are pretty big capital goods. It's a home, right? Now, what are we snapping back to keep that rubber band analogy going, right? We're snapping back to the price of homes in a sense. Keep in mind that we are at two different scales here, right? In red, we're looking at the median price of a home. In blue, we're looking at monthly payments, assuming median income. So that they are constructed off each other to a certain degree, right? But when you think about it in that way, the idea of getting a deal or not, right? You're buying clients ever since, their economic return, response to or I would say recovery from the Great Recession, they've been getting a relative deal, so to speak, on their home in terms of monthly payments for how much home they're getting, right? And now homes are still growing linearly. If this was a one-to-one relationship, these lines would be perfect together. They wouldn't have a gap at all, right? But now that gap's being closed, and home prices are more, monthly payments are more accurately reflecting the price of the home in terms of how valuable that money is, so saith the Federal Reserve. It's an intricate point, but I hope that is conveyed to you guys that we were getting a deal, and now that deal is kind of ending, right? Another way to view that is looking at our historic housing affordability index, right? The idea here is that the higher the number, the bigger bang for every buck you're getting in your home, so to speak, right? And that's we had a sharp downturn in 2021 and particularly in 2022. Why? Interest rates. Let's flip the script here. Let's talk about the silver side. Let's talk about how actually inflation and has been helpful for sellers. You have that asset, you're holding on to it. What does that mean? Why do we say it is such an economic driver, right? In red is going to be the home price that you are used to seeing, that nominal home price that's been reported month after month, year after year, all the way back as long as we've been reporting it, right? Now, because it's a nominal home price, it's always set in the context of our economy, right? And we know that a $300,000 home today is not the same as a $300,000 home in 2003. So let's get the economies of each of those years out of that and talk about just implied home prices scaled to 2003. That's what's in blue here. That's the home price for the price of the home. And red is the home price in the context of our economy, right? And you can see here, I think what's interesting to see is that, let's take, you bought a home in 2005, right? The economy crashed and prices fell with it because within that recession, it was a housing market bubble, right? Oversupply. And home prices fell because of it. Now, ever since that recovery in 2012, it has taken 10 years to come out of 2012 to about 2022 and be about at where that same 2003 context home price was. Which makes sense. In terms of economics, that's accurate. It takes about a decade to grow yourself out of a recession when you're not talking about the greater economy. So why did we say that we got out of the economy in 2015-ish, Jackson? Because we've always had a growing economy, both including housing industry and everything else. The entire GDP of the nation, right? That's included in this red line, right? We have the home that you bought in 2005, home prices fell, right? And then from 2012 to like 2015, that felt like our recovery. And that's the meaningful difference here, right? Inflation is what we're feeling. It's the value of a dollar in the context of the economy, right? And when you try to sell your home, which is, when people are selling their home in the height of the pandemic, they think, whoa, my home is much more valuable to me. That's the price that I want to set it at because it's in that context of the economy. And yes, this gap has shrunk a little bit. I know it's hard to see in scale here, but we've gone down, right? And that is what you're feeling when the seller says, oh, my expectations are up here, and the housing market isn't as amazing as it was in 2001, early part of 2002. Yeah, I hope this shows that this is, the seller side is the exact inverse of this, right? Another way to look at this is the view of homes under a certain price and how the prevalence of homes, in this case under $250,000, has decreased over time, right? You can see we were at about a height of 85% for St. Paul, height of 74% for Minneapolis, and a height of 70-ish for the Twin Cities overall, coming out of the recession. That's the beginning of that recovery, right? It has been, for the most part, on a steady decline ever since. Yes, there was a blip in Minneapolis, but generally it's following a downward trend. And as David likes to say, the trend is your friend. So why are we seeing that disappearing act of under $250,000 homes? It could be that homes are being upgraded. We're adding that extra addition to them, upgrading amenities, all that sort of stuff. But if all those homes stayed the same, or some of those homes stay the same, because the economy itself is growing, the price of that home is going to grow along with the economy because it is a home of a certain standard in a more expensive world, right? So I want to think about this a little bit more, but I want to dive into some preliminary charts that David and I are playing around with. So keep in mind, these don't look as pretty as my other beautiful charts that I just showed you, but they are helpful for you to understand the context of how this particularly impacts sellers, right? This is a chart of the number of homes delisted in the MLS over a 12-month rolling average since 2004, basically. Obviously, we have a bubble. A lot of delistings happened in the recession, and it was steadily decreasing ever since, and kind of hit this linear decrease ever since 2015, right? We then had the pandemic, and fewer people were delisting. Kind of have a dip of sorts here, right? I didn't fill the chart, Brand, for your question on delistings is cancellations and expired. But David's here. David, would you mind telling Rhea in the chat what particularly this is that you built? Is it just delistings, or is it cancellations and expired? Like, is it just cancellations or cancellations and expired? And while we're waiting on that, I will continue in saying that there is an increase in delistings that is eerily similar to the onset of interest rates, which means increased mortgage rates, right? Because there are fewer people willing to buy as hungrily as they were at the bottom of that dip, right? Another way to view this would be the rate of homes delisted. This is looking at that same number, but in the context as what percentage of homes were delisted out of all the homes for that given month that were active, right? And as you can see, this is not as troubling as it looks. The height is at 18%. It's not at 100%. So keep that in mind, right? But we had a dip going through the recession. And as we recovered, we had this, seasonal pattern, slightly increasing up until COVID, a dip from COVID because everybody was ready to sell, right? They were active and happy to be there and put their home on the market. And then when interest rates started, we had a seasonal dip like we are normally seeing. And all of a sudden in 2023, or as we hit 22, going into 23, we spiked relatively, right? Why? David and I think that it is because instead of accepting lower prices, like what we saw in the charts earlier, there are a lot of sellers that are leaving the market and hoping for a better day to sell. So, how deep is the money? Depends on who you ask. If this Jack Russell Terrier were selling a home, I think he'd be on that delisting side. So I know we don't have much time left. We got about 10 minutes. I want to run you through some quick charts that aren't from us, so that way you get a wider perspective than just what we have here at MAR. Home price forecast, we do have a range from what is going to happen throughout the next year, being as optimistic as Realtor.com saying about 5.5%, all the way down to Zelman saying negative 5% decrease in home prices. NAR and Freddie Mac are saying it's going to be flat, and that seems to be the average of this entire group. It's what I'm seeing as well, and kind of calls to what we were seeing with that February median sales price chart, right? So I wouldn't be surprised to see yet another month or so where we're seeing flat. We even see slight negatives. It's not just us. It's likely we're seeing it in other metropolitan areas across the country. And in fact, taking a look at the Case-Shiller Home Price Index of house price appreciation, you can see us in pink here. It's a very colorful line chart. Us in pink down here at the bottom, bit of a silver lining, because we didn't grow at the 35% scales of Phoenix and Dallas and others. We're not seeing the massive drop-offs that we're seeing either. We're still seeing decreases in this Case-Shiller index, or negative price growth. It's still growth, it's just going down, right? It's less growth, but not at the same rate that other people are. Like, again, a silver lining in a relatively dark cloud. Mortgage rate projections in some of the same financial entities, Freddie Mac, Fannie Mae, MBA, and AR, the average of the four, shows that as we get further along in the year, mortgage rates are expected to go down, a normalizing of sorts. And now you're seeing a lot of 5s and 6s on here, and I think some people are looking at that and going, it's not going down fast enough, Jackson. Keep in mind, on the historical scale of things, we are about at where we were, let's say, in 2008-ish. Yes, recession, interest rates, sure, but that is not nearly the heights of what we were seeing pre-2000. That would be a huge negative impact to our industry, right? Yes, it's a spike, especially relative to the past decade. It's a spike. I'm not going to deny that. Like, we've gone up, but we got to understand in the historical context that it's not as bad as it otherwise could be. Now I'm relatively out of time, and I do always want to provide time and space for questions. So, questions. We've got about 5 minutes left. Does anybody have questions for me about either anything that I spoke about today, or general, housing market conversations. I can even pull up InfoSparks for like a minute or so if people have any very, pointed questions. If I don't have any questions, Rhea, I'm going to assume it's just cancellations, because the point of that chart would be that you're intentionally pulling out of the market. But I will double check with David and get back to you. I'm fairly certain it's just cancellations. It's not that you had your listing expire. Lee, I apologize. Rhea. Okay, gotcha. Anybody else? All right, everybody. Thank you so much. See us next time. Let's see. I'm gonna stop screen sharing for a minute here, and I will pull up our next monthly housing market update. Is going to be April 20th, same time, same virtual place. If you are interested, I'm going to put the link in the chat. Go ahead and register right now while you can. Save yourself the time. And until next time, I'll say goodbye, and I'll see you later.